Joining me now is David Macdonald. He's a senior economist with the Canadian Centre for Policy Alternatives. David, good morning to you. So talk to us about the factors behind the increase, and was this expected?
Yeah, I mean, gasoline prices still fell compared to this time last year, but they didn't fall by as much. And so that's one of the reasons why we're seeing an increase in the inflation rate. It's called base year effect. One of the other pieces I think that's worth looking at is the increase in grocery store food prices, hitting 4%. This is the highest that we've seen in almost 2 years. And so this continues to put pressure on households, particularly as a result of higher beef and coffee prices. The other thing I think that's worth looking at is the continued high rent increases that we are seeing, this particularly in places like Montreal, but we are seeing it across the country with the exception of Prince Edward Island. Mortgage interest costs have been slowly decreasing. The big increases in mortgage interest costs happened more than a year ago, and so as a result, mortgage interest costs are still really high. It's just that they aren't going up nearly as quickly, and they are continuing to go down. Rent costs are not. They are continuing to stay high year over year, and so continuing to put pressure on households that rent. And this is all filtering into this slightly higher inflation rate this month of 2.4%, still within that 1 to 3 range, but certainly higher than last month.
So what are you expecting in terms of a rate cut at the end of the month, David?
Well, we've got what may be more important information coming out this Friday, which is the GDP statistics. So certainly we've been seeing inflation rise a bit, slightly more, I think, than the bank had predicted, but not devastatingly so. One of the big differences from the bank projections this summer was the pretty precipitous drop in GDP in the third quarter. The second quarter GDP was negative. That wasn't a big surprise. This was a hit of the tariffs. It's about negative 1.5%. The third quarter, it looks like, will come in at about 0% growth. That's not good news, but it is far less than I think the bank predicted in its July projections. And so I think you've got these two pieces where inflation is certainly a bit higher as a result of food prices, but GDP in the third quarter is far lower, likely will be far lower. So I think that'll probably put pressure on the bank to reduce rates again, which will pull down mortgage interest costs and potentially have an impact as well on rents. But we'll have to wait and see for that next week.
Yeah. You think a quarter point, or how much?
I think a quarter. I mean, it'd be interesting to see more than that, a half. Of course, the bank hopefully is not looking at these day-to-day statistics and saying, oh, we got this data 2 days ago, we're going to make a change today. I mean, these interest rate changes take a year and a half to have a full impact on the economy. And so we have to look out a year and a half and what are we likely to see. I think at this point, it's probably pretty clear that the Trump administration is not interested in completely shredding the Canada-U.S. Free Trade Agreement, CUSMA. They are particularly interested in shredding particular parts of it when it comes to steel production, aluminum production, auto, aerospace. I mean, these are areas that are probably already in recession and will be in recession this year. But I think broadly, we're not likely to see big increase in tariffs outside of that, except in particular areas like lumber and furniture production. And so I think we're likely to hobble along in this very difficult environment. What that means is hopefully the bank is looking a little bit further forward to what's going to happen a year, 2 years from now, and projecting for that as opposed to what happened 3 days ago in the GDP statistics.
David, thanks so much. David Macdonald is a senior economist with the Canadian Centre for Policy Alternatives.